Welcome to the podcast on the changing landscape of transfer pricing. In this podcast, we aim to discuss some of the prominent ongoing topics in transfer pricing arena. I am Nupur and I have with me Sachin, an expert in transfer pricing with over 20 years of experience. Sachin, welcome to the podcast and it's very good to hear your insight on various ongoing transfer pricing topics. Coming to the most debated topic surrounding intangible, what role do intangible assets play in transfer pricing and how are they valued and allocated among related entities? What challenges arise when determining the arm's length price around intangibles? I know there is no straightforward answer to this question, Sachin, but it would be great if you can throw some insights.
I think first and foremost, there's a very significant recognition that intangibles are overshadowing tangibles in a significant way. Just by looking at the top, 10 or top 50 of the largest corporations, you already see how significantly their market capitalization exceeds their net worth, and that is itself an indication of the role of intangibles given a ratio of capital market cap to net worth, and also of course the fact that much of what is developed by these companies is less tangible and more intangible, whether it is by way of content or it is by way of forms of services that are intrinsically linked to intangibles such as software. I think of course the fact that hardware in a sense at one point was driving software, but what is now also happening is that the ubiquitousness of devices has proliferated in a manner where apps have in a sense taken over hardware so significantly that a piece of hardware can support a gamut of software, which only means that overall the value creation is tending to become more and more heavy on intangibles. I think so far as the transfer pricing elements of intangibles are concerned, it largely follows the DEMPI construct, development, enhancement, maintenance, protection, and exploitation. And for most of these factors, there is a increased emphasis on people functions that support the DEMPI, and therefore the former adage of having principle-led structures with low substance in the principle and much of the contributions being made in respect of DEMPI functions by service providers, but those service providers being compensated through a basic return, all of those are now not valid anymore. But having said that, I think DEMPI is being stress tested because of mobility and the fact that there's remote work in many different regions, and therefore the place of consumption, the place of creation is being, and of course there is AI to compound it further. So in short, DEMPI had a certain relevance, but even that relevance is now being stress tested. It was useful to provide a lot more structural or substance-based framework, which is now again coming under the scanner. But if it was not for mobility and if it was not for AI type challenges, then DEMPI would have served us well. But it seems like that train in some sense seems to be already leaving the station, given how rapidly advances are taking place around us.
Yeah, completely agree. And we also have a concept of hard to value intangible.
Particularly when one concerns itself with data and the fact that there is now data created out of data, and then there are these derivatives of derivatives of derivatives, as it were. There is things like property that lies on the metaverse that can be then transacted with crypto, which is like 3 levels of derivatives. So therefore it is very hard to deal with such more esoteric forms of intangibles. But I think at one level, what is very clear is that the concept of migration of intangibles that used to take place to low tax jurisdictions is now becoming more and more a thing of the past because of two reasons. One, the minimum tax that is being applied in as a result of Pillar 2 across jurisdictions, and second, the fact that it needs to be supported by substance or by significant people functions that support TEMPE, and therefore having intangibles absent the some construct of TEMPE around it is again something that is not advised.
An associated question, since you touched on global minimum tax, in light of these developments, what newer trends and structures you see often that companies are moving into?
So it's a very good question, because I think what we are seeing is the fact that the cost plus is not the universal truth for service providers. More and more, as jurisdictions start to become level playing fields, we are starting to see result apportionment, and I call it result because it could be a profit, it could be a loss, but result apportionment and a more equitable distribution between source and consumption. The source country that produces the service and the country that in a sense is the beneficiary of the service. I wouldn't say consumer, because consumer could be a third party, but or could be a third country, but just the beneficiary of the service, if you will. That relationship is becoming more equitable than in the past, and therefore we are starting to see more profit allocation or result allocation mechanisms that typically could take the forms of residual profit allocation of residual profit split, and also that the rise of market power is causing DSTs to pop up all over, and therefore that adds one more layer of tax, although it may not be the income tax construct, but it does add one more layer of tax, or one more layer of so-called profit which has a tax element but possibly not a per se or a profit element. So you're dealing with tax absent profit insofar as the DST is concerned, and then of course you have the result allocation between jurisdictions of production and jurisdictions of that are the owners of the produce.
That was a good insight. We see increased movement towards transparency, and like in Europe, there's already a law for public reporting of CbCR. Many other jurisdictions are evaluating proposals to go for public CbCR. How can companies ensure compliance with public reporting requirements while safeguarding their sensitive business information? Any thoughts around this point?
Yeah, no, I think the fact is that just like you would expect to see cooperative audits between jurisdictions and exchange of information between revenue authorities becoming more and more common, you do also expect to see shareholders today, and shareholders are, let's call it, category of stakeholders. The stakeholders extend to being suppliers, could extend to being customers. So there is greater expectation on the part of stakeholders, but in particular, let's just focus on shareholders, to understand the nature of their company in which they have invested far more closely, with a view to look at whether they are being good corporate citizens by paying their fair share of tax. And the fair share of tax is not only a function of tax rates, which, as we just discussed earlier, is getting more and more stabilized globally, but also a function of whether the relevant amount of profit that is generated in each jurisdiction is commensurate with the capital invested, the people that are in location, the assets that are in place, and of course the intangibles, and to what extent these intangibles play a role in country and out of country, particularly if you think of the fact that many of these intangibles could potentially be out licensed to many other jurisdictions. So therefore there is a greater inquisitiveness on the part of even organizations such as the Tax Justice Network and Oxfam, which are NGOs but call for a public scrutiny of information which is like the world on a page in respect of global corporations. So there are, I think, a multiple number of factors like the perfect storm. If you think about it, there's the government, there is stakeholders, there is the ESG brigade, and so many actors that are calling for more disclosure, and the fact that if the CbCR is anyway within the hands of the revenue authorities, then what is it that needs to be, why is it that it needs to be shielded from all the stakeholders? That is increasingly the question that all the stakeholders are asking, particularly given that multinational corporations have consumers in practically every country around the globe, particularly those ones that deal with intangible property, and also that their suppliers are again widespread. So because of this activism, there is a growing need for an inevitability towards public CbCR.
Yeah, true. But there is some sense of resistance. You mean that when it comes to public disclosure of CbCR, is this something that you feel or see that MNCs are a bit resistant when it comes to disclosing or going for public disclosure of CbCR?
Well, I think in some sense, how much profit is to be residing in a jurisdiction, or how much revenue is to be allocated to a jurisdiction, tends to put the spotlight on that jurisdiction, not just from a outsider point of view, but it does present more. It does put the scrutiny even of the tax authorities on jurisdictions that tend to have higher levels of profit, and therefore the concern is that there would be an unequal distribution of wealth, possibly, that could become evident when public CbCR comes into play, and I think that's the apprehension. But if you think of the extractive industry, they've already put out public CbCR for extractives, and that might be a good indication of how industry is also responding to transparency and governance. So I think, if anything, this is probably one that is in a transition phase, and I think over a period of time, just as the idea of having a global minimum tax has eventually percolated to many countries, it is likely that public CbCR will also percolate to many corporations, because remember, countries like Australia that have promulgated public CbCR are saying that countries that are not just headquartered in Australia, but companies that are having any form of presence should make their CbCR public. So it does mean that practically every company that has filed its CbCR will have to eventually go public, irrespective of where it is headquartered. So I think all of these we are at an inflection point, and we should expect to see public CbCR become a way of life.
Yeah, I couldn't agree more. Coming to the last question around dispute resolution. Dispute resolution is a critical aspect of transfer pricing. Our listener would like to know about effective strategies for managing and resolving transfer pricing dispute with tax authorities. What are some of the best practices and alternative dispute resolution mechanism available to the companies? What would you suggest, Sachin, in this case?
Yeah, I think the nature of transfer pricing as being so fact specific and so dynamic means that one has to constantly be agile insofar as uh, controversy management is concerned. And Nupur, you would appreciate that we do have to look to the hedging risks as well as optimizing outcomes.
Yeah.
Because if you go through the litigation process, that could result in a certain outcome that is largely based on legal principles. If you went through a negotiation process between competent authorities, that could result in an outcome that's negotiation based, but it may be drifting away from merit based arguments. And then if you went through a mechanism that was forward looking, such as one that would go into an advanced pricing agreement, it could be the case that your critical assumptions in a given year could go out of the window because of a certain event that took place in the company or in the macroeconomic environment, such as a recession. And if you went through a safe harbor rule type approach, then either it could get questioned in the other jurisdiction, or for that matter, it might just mean having to pay somewhat of a premium out above arm's length price. So there are a whole array of possibilities and choices. I think what companies need to do is to evaluate for themselves as to what is the most predictable and the most and thereby choose what is the most optimal form of dispute resolution. Also, it's cultural. So there are some companies that are willing to fight tooth and nail to the last dollar, as it were, and those companies would then be advised to follow a litigation route, because most of the times we have seen outcomes in litigation being going in favor of the taxpayer, simply because transfer pricing is so fact specific that unless one is very far away from the application of the right method, you would expect that the business will take its most sensible call insofar as application of methods and comparability analysis is concerned, and that therefore it is quite likely that the taxpayer will prevail in a litigation scenario if it has a reasonably good case. But litigation comes with the expense of time. If you think about if a company has more predictability around its revenues and is willing to look long term and or has the luxury of looking long term, such as one that is in a high profit industry, then it would be well advised to go into potentially a bilateral APA, because those outcomes are more reasoned, more based on arm's length principles, and they are negotiated by the competent authorities. And then again, if one is looking to get certainty for a relatively small scale business, or one where the transaction values are small, and is willing to therefore live with a premium for certainty in the short run, then a safe harbor might be a good approach. And then of course there are evolving mechanisms such as bilateral safe harbors that are talked about, or industry bound APAs that could apply to medium and small scale enterprises, or the ICAP, which in a sense represents a risk assessment come joint audit. So these are again evolving phenomena which we will expect to see. But and of course, for that matter, even Amount B, which is also on the anvil. So these are still evolving, and I think that taxpayers would benefit from having more than less in respect of dispute resolution and prevention.
Yeah, I would agree that it's more about situation analysis also, and everybody needs to evaluate their own situation and decide whether they want to opt for dispute avoidance measure or dispute resolution measure, like you said. That concludes today's podcast. We hope this podcast was able to shed some light on these complex topics and provide some valuable insight. Thank you, Sachin, for providing such valuable insight. And thank you all.